All right, well, good afternoon, everybody. This is Jim Musgrave with Research Financial Strategies, and welcome to our 2014 kickoff investment call today. Joining me on the call are portfolio managers Jack Ruderman and Danny Harbison, and we hope you had a wonderful time over the holidays and you are as excited as we are about the upcoming year. We know you guys are busy, so I'm going to keep it brief and kind of get straight to it. Today I'm going to be covering, let me go to my agenda right here. My computer will catch up with me in just a second. But today I'm going to just do a brief review of 2013, and then I'm going to hand it off to Danny and Jack to talk about the bond market, stock market, our current positions, and then we'll open up for some Q&A. I put our websites at the bottom of the slide because there's a wealth of information. I know that Jack has been updating the Research Financial Strategies website, and I'm in the process of updating my website as well and putting some great content on there. So certainly refer to those websites on an occasion. So I want to kick it off right here with some positive signs. So these are some leading indicators, and we can see that light vehicle sales have slowly increased over the years. We've reached over 15.2 million last year. And so that's a very good economic sign. Obviously, housing starts are improving since the housing bubble burst back in 06 and 07. The manufacturing and trade inventories are doing well, and again, there's good turnover right there. It means that there's demand for manufacturing and inventories, as well as real capital good orders are increasing. So we've had some positive things in the market. Obviously last year kind of surprised a lot of us because we started off with the fiscal cliff. We avoided the cliff, and the market kind of took off. The market actually shook off the sequester, and Bernanke actually talked about tapering the bond buying, and that kind of spooked the markets a little bit. We dropped roughly 10%-ish in the summertime. We also had the uncertainty of the government shutdown, which actually happened, which certainly hurt things. But after that was resolved, we had a very positive fourth quarter. So the good thing is that we actually have a budget for the next couple of years, and it seems that the Democrats and Republicans are actually talking to each other, at least for this brief period of time. So I think if there aren't any major hurdles or bumps in the road in terms of our, politically speaking, the market will continue to do fairly well. So anyway, a couple things I want to kind of touch on. One is the unemployment and also the GDP. Again, the average GDP over time is roughly 3.1%, but right now we're about 2%. So again, we're making progress, but we're not quite there yet. And so, again, it's been a slow recovery, but again, we just kind of continue just to grind it out. In terms of the unemployment, again, the Fed, as you know, has a dual mandate, keep unemployment down and keep inflation low. The Fed says it won't raise interest rates until employment gets down to roughly 6.5%. We're down at roughly 7%, so we are making progress. It's just slow progress. And so, again, who knows when the Fed is going to raise rates, but I don't see that happening for at least another year or two. But we'll be positioned and watching that very closely to see, if interest rates continue to rise and how that affects the bond markets. And so, again, we just hope that unemployment rate will continue to drop, and that will certainly improve things over time. In terms of the interest rates and inflation, this is a very important slide because it really kind of shows you how markets react in a rising and a falling interest rate environment. On the left side of the screen, you can see, basically in the late mid-50s, interest rates were low, and as they peaked in the early 80s, how that affect things. And so, as you know, bond prices go in the opposite direction of yields as well as interest rates. And so, since since 1981 to the present, we've been in a bond bull market. As you can see, as the interest rates have dropped, bonds have done historically well. But if you look at the very right of your screen, you can see that little uptick right there. And so we may have seen the end of the bond bull market. And again, we've talked about this on several calls before, and I've showed you this chart before, but this is the 10-year Treasury, ticker TNX. And you can see in May of 2013, that's when the 10-year Treasury yield started to spike, and it continues to go up, and that's that has been the trend since May of 2013. Why is that important? It's important for a number of reasons. One is again, to go back to bond prices go in the opposite direction of interest rates and yields, and so as we've seen the 10-year Treasury yield go up, it's really hurt the bond market pretty much from May of 2013 on. The other thing is, again, the mortgage rates and the rates that we borrow money from are based on the 10-year Treasury. The good news is that even though a 30-year mortgage has gone up slightly over the last year, historically it's still very, very low. So I don't see the 30-year fixed mortgage rate getting in the way of housing improving over time. So if we look at the bond market right here, you can see just at the same time as the 10-year yield was going up, the bond market started to drop, and that's kind of where we are right now. And for those of you who may not be familiar with how the interest rates affect different types of bond classes, basically what this slide shows here on the right-hand side is that the longer the maturity or duration of the bond, the more vulnerable it is to interest rate risk. So if you had a 1% rise in the interest rates, a 2-year Treasury would be negatively affected by -2, opposed to a 30-year Treasury that would have a -18% drop for every 1% rise of interest rates. And so for quite some time, we've been buying shorter-term duration bonds because we knew that this interest rate risk was coming. And then again, May of last year, that's when things started to turn around. And so at this point, I'm going to hand it over to Danny Harbison, who is a bond portfolio guru, and he's going to talk to you a little bit more about what we're doing with our bond portfolio and what we see moving forward. So here you go, Danny.
Great. Thank you, Jim. I'll keep this relatively brief. I'm going to try to steer clear of getting too technical on the call, but I want to give you guys kind of an idea of what we went through in 2013, because it was an incredibly critical year for the fixed income market, and kind of what we're anticipating to go through in 2014, and how we are adapting, evolving, and handling that side of the portfolio. As Jim said, May of 2013 marks a critical inflection point as far as interest rates are concerned. We saw the rates all over the yield curve for the 5-year, 10-year, 30-year yields just shoot right through the roof, and that bodes very poorly for the fixed income market. Since about the mid-70s, we have been in a fixed income market where you could essentially throw darts at a board to come up with the client's fixed income allocation. Obviously, we would never do that, but I'm trying to get the point across that it was very, very widespread bull market for bonds. You could pretty much pick anything and get between 3, 4, 5, 6% a year. We saw that hiccup in 2008, where fixed income prices took a little bit of a hit due to liquidity reasons. However, we are in a scenario where this could be changing the landscape of the fixed income markets for quite some time, and it's going to be extremely important that that you're actively managing that side of the portfolio. You can no longer set it and forget it. That's what people do as far as the pie chart goes on the fixed income side. It's going to be very, very hard-pressed to find fixed income positions that are going to perform well in a rising interest rate environment. So what we did right around end of May, beginning of June, we started liquidating our fixed income positions because we apply our technical analysis to the fixed income portfolio as well. So when we saw the increased risk and the increased momentum in the yield curve, we didn't, that's a major red flag. So we started to scale out of our fixed income positions right around the beginning of June. We were able to significantly avoid about 95% of the mayhem that we've seen rattle the fixed income markets over the course of the last 6 or 7 months or so. So, you know, sometimes it can get a little bit frustrating, but sometimes cash is the best asset class, even on the fixed income side. And when you're in an environment where we have such a significant amount of interest rate risk, it's important to utilize that cash. And that's something that we did over the summer into the fall. And we currently still do have a pretty significant cash position in our fixed income model. We're kind of waiting for the dust to settle and pick our points, so to speak. However, that being said, I do think that we are on the cusp. We're kind of at the beginning of the end here as far as the bond bull market goes. I think that we're probably going to see a very choppy interest rate environment going into 2014. We may not see as severe or significant of a spike that we saw in May of 2013. However, I do think that we're going to continue to see interest rates rise across the board, especially as the Fed starts to increase their Fed funds rate, which is essentially the overnight lending rate from bank to bank. So, you know, what does that mean for you? Well, let me first tell you what that means for us and the money management business as a whole, because I did say that this is kind of an unprecedented scenario. It's a scenario we haven't seen in 3 decades, and it certainly hasn't come to fruition yet to the point where you know, we can say that you know, rates are going to just continue to go through the roof. We have seen that happen for the last 8 months. We could see a little bit of a cool down as far as interest rates go, but big picture scenario is that we are in a very, very high risk on environment in the fixed income markets, and if you're not careful in managing that risk, you can get severely burned. I was actually reading an article the other day that was discussing hedge funds that deal specifically with fixed income for their clients, and the majority of those hedge funds were down anywhere between 4 to 8% in 2013, and these are conservative fixed income models. You know, I know that if you guys looked at your statements and you are, you know, you're a conservative investor, I don't think you'd be very happy with a negative 4 to 8% return in something that you were under the impression was conservative. So what that means is you have to be actively managing that interest rate risk, and we're able to do that through a couple of different ideas, and then I'll pass it over to Jack. I just want to touch on kind of how we're currently allocating and how we're managing that interest rate risk very quickly. What we're able to do is, as Jim had kind of touched on it, that the longer the maturity and the duration of the bond, the higher the interest rate risk, the higher the volatility. So, you know, you get a 1% movement in interest rates, the higher your duration, say you have a 10-year duration, that bond's price is going to take a 10% hit. If you have a 5-year duration, that bond price is going to take a 5% hit for every 1% move in interest rates. So you're able to manage that risk by shortening your durations, which is something we've been doing for the past 1.5 years. So this certainly didn't come by surprise. We've been preparing for this for quite some time. We're also able to kind of go outside of the fixed income box and allocate our clients into investments that have exposure to convertible bonds, which are essentially, they behave a little bit more like equities. They don't carry nearly as much interest rate risk, but they also do have that fixed income engine to them where they're paying you know, a 3.5–4% yield on a monthly basis. So there's still areas where we're able to add value in the fixed income model. I don't want to be too doom and gloom, But I also do kind of want to toot our own horn. In 2013, we were up just a little bit over 1%, which certainly does not sound very exciting, but the AGG, which is the fixed income benchmark, was down about 4.5%. So we were ahead by about 5.5% on the benchmark, and we stayed in the black throughout the year, which is a nice thing. So, I do think that there's going to be more room for returns in 2014, but I also think it's going to be an extremely high risk-on environment, similar to what we saw in the summer of last year. So that's all I have. I'm going to turn it over to Jack. He's going to touch on the equity model, what we're currently holding, and go over some other stuff related to that.
Hi, good afternoon, everyone. Glad you're all here. To segue off of what Danny said, we have the AGG up on the screen, and you can see it opened the year somewhere in the vicinity of 112, and it closed the year around 107, and it was as low as 105. So a lot of people got a rude lesson last year. A lot of investors, a lot of clients walk around in a fog thinking that bonds can't lose money. So last year was an exercise in which people learned very painfully that bonds can lose money. The AGG, as Danny mentioned, was down over 4%, almost 5%. I can't remember how far back you have to go to find a calendar year where that happened, but it's been quite some time. Before I switch screens, I want to point out the inflection date. The inflection date is right around May. In early May, Ben Bernanke started speaking. You can see there was some deterioration before that, but the famous Ben Bernanke speech, I believe, was about May 7th, and that's when he tanked the market by threatening or suggesting that he might discontinue the $85 billion of quantitative easing. I want you to visually hold that in your head, because as you all know, stocks and bonds don't always correlate, but sometimes they do. And what you're going to see here is in the stock market, using the SPX as our benchmark, we had several inflection points last year that I want to discuss. And one of the very, very first inflection points is I'm going to take you back to May. So here we are. That 6 is approximately June 1. That 5 is approximately May 1. And as you can see, everything was going along quite well. We were having a really good year. We did have a little weakness in March due to the battle over sequestration, but that turned out to be a 2-3 day blip. So basically, we had a pretty strong start to the year, a great January, a great February, a little bit of a sell-off in the spring due to sequestration, and then a major spike in the S&P from 1540 to 1685. And then Mr. Bernanke opened his mouth, and you can see that exactly what Bernanke's comments did to the bond market, they precisely did to the stock market. The stock market, again, using the S&P 500 as my benchmark, the stock market pulled back from 1685 to 1565. That's a loss of about 8-9%, and that almost perfectly paralleled what happened with the bond market. So this was our first real danger zone in 2013, and we moved assets to the sideline. We started rebuilding portfolios in July. Here we have a traditional double top, and I believe sometime in late June, early July, I don't have the date in front of me, but we started rebuilding portfolios. And then sure enough, we get into another panic. This panic was pretty much, I believe, if I remember correctly, this was the budget battle, or was this Syria?
It was.
I think it might have been Syria.
It was Syria.
Yeah. Right.
That was in 9/11.
Right. So the next sell-off we had came in late July, early September, and that sell-off was caused by concerns over Syria. Again, John Kerry and other people within the administration were able to put that aside, and by September 1, we have another double top and another takeoff from a low of what had been 1630 all the way back to a new high of 1725, and then another sell-off in October, and that was caused by the government shutdown. And the government was shut down 16, 17 days. There's October 1, somewhere in the vicinity of October 18th. The compromise was achieved and the market reopened, and we have a rally off of 1650 to a new all-time high just this week, yesterday, of 1850 and 1845. So that's sort of a recap of where we are. If one were to simply look at this point to point, the market did quite well. Actually, I call this Mr. Toad's Wild Ride from Disney World. There were at least 3 times sequestration to a lesser extent, but at least 3 times quantitative easing discussions by Mr. Bernanke, the Syrian concerns and possible war, and then the government shutdown. There were at least 3 times where the S&P could have cratered and headed significantly south. That did not happen. We had 3 distinct corrections in 1 year. That's possibly historic. I think each of these 3 was in the range of 9 to 10%. That's very unusual. But we've basically been fully invested since mid-October. We did swap out some positions in December. I felt the market was getting overpriced at this range, and we got rid of our small cap position. Historically, small cap will be the first thing that will show deterioration if we do have a market sell-off. So back in early January, I got rid of IJR Small Cap 600, and we replaced it with SSO, a double S&P 500 fund, which gives us 20% large cap exposure. Our other positions that we're holding, some of them we've been holding as far back as July. We never got rid of RSP, which we've owned since July 10th, and it's up a very outstanding 13.4%. We also own Midcap 400. It's up about 10%. We own Triple Q, the technology index. It's 11.55 to the positive. XLY and IYT and XLB are sort of a triple consumer play. All 3 of them are posting very significant returns. XLY is up almost 9%. IYT is up over 12% since we bought it, and both of them are beating the S&P since the day we bought them. Where you're liable to start to see weakness in the market, as I mentioned before, the first place is IJR. The second place is going to be the combination of XLB, IYT, and XLY. XLB is materials, and materials, of course, have to get somewhere. And once they get somewhere, to a factory or an assembly plant, then they're changed into goods, and those goods have to get somewhere. So one of the major indices that economists always look at is the transportation averages. Because of the technology of our modern economy, we're no longer an agrarian society where we grew our own wheat and we made our own bread. Today, virtually 99.9999% of everything, with the exception of the tomatoes you grow in your backyard, virtually 100% of everything in our modern society comes to us by either truck, train, or airplane. It's virtually impossible for you to think of anything that touches your daily life, your bed, your shoes, your clothes, your toothpaste, your carpet, your car, the gasoline in your car, the newspaper on your front porch. It is virtually impossible, with the exception of air, for you to think of anything that touches you on a daily basis that did not get there by either truck, train, or airplane. So IYT is the exchange-traded fund that owns all of the U.S. domestic carriers as they're generically known. All the trains, all the truck companies, and all the airline companies. That is an extremely key economic benchmark. If we start to see IYT deteriorate, that is an indicator that tells us the revenues of these trucking, airplane, and railroad companies are declining, which means they're processing fewer and fewer shipments. Once that Ford F-150 gets to the car dealership, or once that iPhone gets to the iPhone store, or that gallon of orange juice gets to the giant food store, a consumer walks in and buys it. And that's really what the XLY, Consumer Discretionary Fund, tells us and monitors that from a supply-demand point of view. It is the discretionary bucket as opposed to the non-discretionary bucket. So the discretionary bucket is you may or may not want to buy a new iPhone, you may or may not want to buy a new watch or a new Ford pickup truck, but you're definitely going to go out and buy groceries even if you're on a borderline poverty level. You're going to be buying some type of groceries and making your rent payment. So XLY tracks what we call discretionary spending, which is the consumer coming into the Apple store and taking that Apple iPhone off the shelf. If IYT and XLY together start to deteriorate, that is a key economic indicator that Danny and Jim and myself are going to be following and we're going to be watching, and that could be the beginning of a correction in 2014. A lot of the political stuff we're concerned about has somewhat been taken off the market. We don't need to worry about sequestration again for another 2 years. Most of the budget has been resolved. There are still some amendment issues that they're fighting over. So I don't think we're going to see another battle over sequestration. I don't think we'll see another battle over government shutdown. We will continue to see some infighting on what the final budget looks like, but I think both parties have basically said they want to keep it as peaceful as possible because both parties think they own the hearts and minds of the public, and right now both parties believe they're going to walk away with victories in November 2014. So a lot of the politically motivated things that I was concerned about last year have been taken off the table. We're still dealing with Syria, the Middle East, Benghazi, Israel, Iraq, Iran. Any one of those types of events could create panic selling and a correction. So we're going to continue to monitor those events as well. Right now, we are on a technical buy. You couldn't ask for a better looking chart than the one that you're looking at, the SPY. It's on a technical buy. It's in a double top. It's recovered 1845, which it got to in late December, and then it gave back in early January. So it's recovered to the 1845 level this year, mainly yesterday, and today we're looking at another new high on the S&P of 1850. So we are on a technical buy. We are 80% invested. We may be committing the remaining 20% cash, and until one of these indicators or political events raises its ugly head, we're going to stay invested in our stock portfolios. Jim, that's all I have.
Okay. Jack, I was wondering if you could possibly explain why we would have a 20 or 30% cash position versus being 100% invested. Is that a risk management tool that we're doing? Maybe some of the callers would like to understand a little bit about cash positions.
There's two pieces to it. Creating cash is a risk management position. Risk management response. When I sold off IJR, I knew at the time I sold it off I was going to replace it with the S&P 500, and I replaced it with $2 of the S&P 500, and I've been checking these numbers every single day. Every single day since I got rid of IJR, SSO has outperformed. Also, in all humility, Danny and Jim and I are very, very good at picking ETFs that provide positive alpha. Alpha is how much we overperform the S&P by. So yesterday, using yesterday as an example, the S&P was up 108 basis points. Our portfolios were up 100. Well, that spread is only 8%, but we're sitting on 20% cash. And the reason for that is all of our positions, with the exception of one, dramatically outperformed the S&P for one day. RSP pulled in 115. IJH pulled in 123. Triple Q pulled in 191. XLY was slightly below at 86. And IYT is at 133. So make sure everybody follows the technical definition of alpha. If IYT was up 133 and the S&P was up 108, our selection of IYT versus the SPY, that added an extra 25 basis points to the performance. So being 80% cash, we should have only been 80% of 108 yesterday. Instead, we were well over 80% of 108. We were at 100. Conversely, the day before, Monday, the day before yesterday, when on Monday's huge sell-off, we outperformed by about 20 basis points, meaning our portfolios did 20 basis points better than the S&P. So we've been able to pick sectors and ETFs that, with an occasional exception, have outperformed the S&P and given us positive alpha. And on most days, we've either matched or beat the S&P, but we've kept 20% of our cash dry. If we continue to have a positive trend, we will commit that extra 20%, and then we're going to have a margin that pretty much guarantees us to not only match, if not beat the S&P, but beat the S&P by a significant percentage. And that's really what our job is. The job of a money manager is to beat the benchmark and at the same time to provide risk protection to the downside, and that's why we keep a little bit in cash, so we have some maneuvering room if we need to add positions or refocus our direction.
That's a great explanation, Jack. So I'm going to open up the lines to ask any questions. I have everybody muted right now, so if you could just kind of keep the background noise to a minimum, I'm going to open up the lines here and answer any questions that you guys have. So the lines are unmuted. Amos or Larry or Ryan or anybody there, do you have any specific questions for Jack or Danny?
One concern was the amount of cash available, but I think he answered that.
Okay. Any other questions, Larry? I know that was something that we talked about. Obviously, it's a risk management thing. Also, we have some more dry powder, so when we do see opportunities that we can buy positions that we feel that will be beneficial to the portfolio.
Do you limit the number of ETFs that we own?
No. I could go as high from a practical point of view. I could go as high as 20. We don't like to do positions below 5%. It becomes messy and cumbersome when you're dealing with thousands of client portfolios. In the past, we have owned as many as a half a dozen 5% positions. The real problem right now is there's not a whole lot out there that I like. This really is a shallow market, and by shallow market I mean you have a lot of sectors that are underperforming the S&P. You've got a lot of retail that's hurting. There's a lot of industries that are still hurting and are not reflected properly in the S&P 500 because the S&P 500 by definition is market cap, and it rebalances itself once a quarter, so it rewards good companies and punishes bad companies. But technology is absolutely in the toilet, with the exception of Google and Apple. Big names like Cisco, Intel, Verizon, Hewlett-Packard, Dell, all of those big names are selling way below where they were 3, 4, 5 years ago. And I'm concerned about that impact on the economy long term. And we still have a very shallow recovery. A theme that both the Republicans and the Democrats talk about is the shrinking middle class. Right now, about 51% of the population controls 1% of national gross income, and 75% of gross income is controlled by the top 20% of the population. So that doesn't bode well for apartment builders, home builders, automobile dealers, truck dealers, appliance dealers. We've seen what interest rates did to the housing market. We had a great run in housing from November of 2012 through this past July. So all of your housing companies, Lowe's, Home Depot, all of those organizations have been below their highs from last summer. So again, I don't know where this is going to end up. I'm not making a political statement. I'm not, crying wolf or the sky is falling. But I will tell you that the economy under no conditions is as healthy as it was in the summer of '07. And a big disconnect that people play, and not to make a political statement, but the administration plays this. The administration says, look at the stock market, it's at 1,800. We've recovered everything and we're back to a higher high than we were in October of '07. That's mathematically a true statement. But if you look at the dollars on the table, it's not a true statement. You're looking at an index. So an index of 1850 is higher than an index of 1565, which is where it was in October of '07. But total U.S. stock market capitalization today is lower than it was in October of '07, and total U.S. domestic wealth, including the value of real estate holdings, is lower than it was in October of '07. And the only piece of the real estate market that's really recovered is low-priced housing below $500,000. Stuff over $500,000 and up over $1 million, if you eliminate your super wealthy pockets like Great Falls, McLean, Potomac, Naples, Manhattan, San Francisco, if you eliminate the super wealthy pockets, the majority of real estate in the country is still valued below where it was in October of '07. So to say the S&P 500 has recovered and therefore wiped out all of the damage of the Great Recession is not only misleading, it's factually incorrect. The S&P 500 has recovered to a higher level than it was in October '07, but all other measurements of wealth, income, real estate valuations, personal income, gross domestic product, all other measurements of wealth and income today are below where they were in the summer of '07. So we have not recovered from the Great Recession. We are better off than we were in March of '09, but we've not completely recovered from either an employment point of view or a real estate market value point of view or a total national wealth point of view. None of those major indicators are back to where they were in the fall of '07. So we have to be very, very careful what we buy. There's going to be a lot of weakness in retail. You're going to see a lot of retail and restaurant bankruptcies this year. And you're going to continue to see the big tech firms, especially on the hardware side, not do well. If you have a 2-year-old Dell computer for $400, I doubt if you're going to go out and buy a new one just because it's on sale for $380. So hardware on the tech side is not going to have a good year. There's a limit to how many big screen TVs you're going to go buy. And again, if you're part of that 51% that is at or below the poverty level, you're not looking at granite in Home Depot this weekend or big screen TVs in Best Buy. So you're going to see some major retail and restaurant bankruptcies this year. And until we deal with the real unemployment number and the underemployment number and the shrinking middle class, we're still going to have some serious, deep economic problems that do not mysteriously go away just because the S&P hit 1850. So the S&P hitting 1850 doesn't make these problems go away. The unemployed lawyer, the unemployed accountant, the real estate settlement attorney who used to make $500,000 and is now making $75,000, the unemployed car dealer finance manager, none of those problems go away just because the S&P is at 1850. So this country still has some very serious economic problems that need to be dealt with, and those economic problems are not reflected in the good news of the S&P hitting a new all-time high of 1850. Jim?
Any other questions, anybody?
When do you think the economy is going to recover?
Sorry, what was that again?
When do you think the economy is going to recover?
I'm not allowed to answer that question.
I'm not sure.
I will if Jim lets me, but I probably should not.
I think what we've seen is a very slow recovery. Going back to those economic things I showed at the beginning of the call, it's a slow, grinding recovery. Again, GDP is around 2%, where the historical average is 3.1. So I think we're going to continue to see very slow growth. That's what I read. I'm sure that's what Jack reads as well. So I don't have a time frame, but I just kind of crossing my fingers that things will slowly get better. And again, I personally feeling that, again, the government is somewhat kind of gotten some of the risk out of the way, getting a budget deal for at least 2 years. So,
And that's not in concrete.
Yeah. So
there's still some issues there that could tumble that.
So I wish I had a better answer for you, but nobody really knows because there's so many variables that we have no control of, and they're constantly changing. So what we can control is how we create our own financial roadmap and make fine-tuned changes, and we stick with our goals. And Ryan, you've done a great job on that. So I can put in things in perspective. What I can do is I can put away X amount of dollars in my retirement account, in my non-qualified accounts, and my Roth IRAs to make sure that I have equal, good amounts of money in all three tax baskets. I can make sure I have the right insurances. I can just make sure that I'm not spending too much and paying down my credit card debt. So
I think the real mandate that everyone needs to focus on for 2014 is don't get greedy, don't get euphoric, and keep what you have. And that's really, I think, going to be the tone of the stock market for 2014. Don't go crazy. Don't start buying nutty technology stocks that your friends at the office tell you about, because they're the same people who lost everything in 08 and 02 and statistically are wrong 99.9% of the time. If you want a guarantee on how to lose money, go to any men's country club locker room after a golf match and buy any name they're talking about in the locker room. There's a 99% guarantee you'll lose money. So this is a year of caution, and this is a year where we need to focus on keeping what we have, because regardless of those double-digit performances we all earned last year, I don't think anybody wants to look at a -10 or a -15 this year. So the real theme that Jack and Danny and Jim are focusing on this year is preservation of principal, risk management, and keep what we got and don't give it back to the next bear correction.
yeah, I'd have to second that. What about you, Dan?
I'd agree completely. I think the party's going to be coming to an end at least by the second or third quarter of this year.
Yeah, we'll see. Everybody has a prediction. One thing I don't see is the market in 2014 doing as well as it did in 2013. So we've gone over our time today. You guys have been a great audience. And so anyway, if it's any other questions, I'm going to kind of end the call here. And again, if you have any questions, you have my number. You can certainly give me a call. We can review things. But again, I want to thank you all for attending the call today. We're going to try to do these on a monthly basis. And until then, you have a good week.
Thanks, everybody, for joining.
All right, take care now.